For the time being, we have to focus on another company, and Ceat is the one that's on our radar. The company, of course, had a management discussion, an analyst day, and it said that the FY25 volume growth is likely to be in high single digits to low double digits. The company also aims to expand into the export market, basically grow its export share. To talk about this and, of course, the outlook ahead for this year, we have with us Arnab Banerjee, MD and CEO of Ceat. Mr. Banerjee, great to have you with us. Good morning. Thanks for joining in. So a lot of the commentary coming in from that analyst day seemed very, very optimistic. And one that particularly caught my attention was how that you're gunning to move from being the third largest player in the passenger radial market to becoming the second largest, and basically grow your volumes, grow your exports as well, but also grow in the domestic marketplace. So let's start there in terms of what the trends are looking like so far into the current financial year, and what's your expectation on volume growth? If you could just break that up into first half and second half, perhaps.
Right. So the first 2 months have started off well, and we maintain our volume growth direction, which is about high single digit overall. But we expect higher growth in two-wheelers, relatively higher growth in two-wheelers in both replacement and OEM. I'm talking about the market first. And we expect about mid-single digit kind of growth in the market in four-wheeler and in MHCV. So as far as we are concerned, we maintain our leadership stance in two-wheeler. We expect to grow faster than the market. And we have been gaining share steadily in the passenger car tire segment in replacement. And we expect if the trend continues, then we would be in a good position as far as relative ranking is concerned by the end of this year.
Right. So optimistic outlook here. We'll talk about the market share in just a bit. Mr. Banerjee, just wanted your thoughts on a very near term on raw material costs, because rubber prices have increased in the last couple of months from 150, 160 rupees per kg to around a little under 200 rupees per kg. What is your prognosis on margins, and what are you thinking of in terms of levels that you can maintain this year? Because that's some thing that may concern the street going forward.
Yes, natural rubber price hike has been pretty steep. In fact, for a brief while, it touched 200 as well. And the other part, which is the crude-based raw materials, they have been a little bit range-bound, so there's some relief from there. Having said that, we expect the raw material basket as a basket to go up by about 5 to 5.5% by end of this quarter vis-a-vis end of quarter 4. And there is also EPR, which has come in as a cost. So overall, we need a price increase of around 3.5 to 4%. In replacement and in domestic OEM business. OEM is indexed, so that will come around with a lag of 1 quarter. We have taken about 1.5 to 2% price hike already in replacement, and we expect to cover the balance by end of this quarter.
What would your margin target for the end of this year be? Last year you ended just below that 14% mark.
You're talking of EBITDA, right? So
yes, that's right.
So as far as raw material is concerned, we focus on the gross margin. We would like to keep the gross margin intact and have more efficiencies in the cost lines, which is between gross margin and EBITDA. Coming to EBITDA, we would like to still continue to deliver EBITDA within a very narrow band with minor fluctuations up and down. There may be a little bit down in the first half of the year when the rates are going up, and when we stabilize, we would like to maintain the same narrow band.
All right, we appreciate. Could you reiterate the narrow band?
Yeah, if you look at last year, it has been around 13 to 14%, a little bit sometimes higher than 14, sometimes around 13 or a little less than 13. So around that zone.
Okay, all right. Hi, Mr. Banerjee, and thanks a lot for joining in here on CNBC TV18. We would like to see you actually more often on the show, so hopefully you give in to our request a few more times. You're doing around 11,500, 12,000 crores on an annual basis. I believe at optimal levels with the current gross block, you can do roughly around 15,000 crores. What is the capex plan that you have lined up for the next couple of years? And in turn, what is the asset turn? What could be the peak revenue potential from around 15,000 crores?
Yes, so we have decided not to have any capex cycle anymore. So there will be steady capex every year. Last year was about 860 odd crores. This year the plan is about 1,000 crores. As we keep growing, it will be indexed to around 1,000, maybe 1,050, 1,011 1,100 kind of crores. So steady capex will not be investing capex in one project at a time. So it will be parts of various projects so that we keep growing. Now coming to the turnover possibility, without the capex of this year, we are good for around 15,000 crores. And if we continue to invest at similar kinds of rates, then we will keep growing beyond 15,000 crore. Let's say by the end of FY26, we may reach an annual turnover rate of around 4 to 4,500 crore per quarter.
Okay, all right. So what is the asset turn, sir? If you put 1,000 crores, how much of revenue can you get?
It's different for different categories. It's very high for two-wheelers, about 1.4, 1.5, and little lower for TBR, which is about 1.2 kind.
Okay, all right. What does it do to the debt in your book, sir? Given that you're going to be incurring closer to 1,000 crores, you're keeping that in mind. What does it do to your debt? So the updated debt number, where does it go? And also, what does it mean for your ROCE?
We have been maintaining, we have reached a level of mid-teens in terms of post-tax ROC, and that's one of the matrices we as a management team are driving internally very hard. And we would like to keep a double-digit ROC going forward. Also generate free cash flow. Of course, last year was very high. We would like to be positive in terms of free cash flow. In the last 8 years, only 5 years out of 8 years, we had positive free cash flow. Going forward, we would like to make it a regular thing also. And so if you focus on ROC and free cash flow, everything else would fall into place.
Sure. Okay. And that your shareholders will like that. Sir, I believe you want to increase the share of exports as well in the pie from about 19 to, I think, 25%. That's the stated objective. Just want to understand the dynamics. Exports, is that a better margin business for you, or are the margins comparable to what you get here in the India business? And by when do you see this scale up happening?
Okay. First things first, exports for us is margin accretive compared to domestic replacement. So it is the highest margin business in terms of EBITDA. And we have primarily 3 markets and 3 categories, which is the agri-radial sector and the passenger car tires and the truck bus radial. Three categories. 3 markets are the EU, in US as well as Latin. So these 3 are the focus areas, and these 3 are the focus markets. And our endeavor would be to take it up to a saliency of 25%, as you mentioned, in 2 to 3 years' time, which means doubling of export turnover in 2 to 3 years' time.
Okay, so exports will help you sort of increase the margin profile as well, and that's the focus. I just want to go back to one number. You said the volume growth should be in high single digits. Were you speaking about the industry or about Ceat? What is Ceat's own expectations on volume growth?
Yeah, so it should be in high single digit to low double digit for Ceat going forward. It depends on how we sustain the growth rate, which is, Q1 is a seasonal month, positive seasonal month. So we usually start off well in Q1. If we sustain this, we are looking at high single digit to low double digit kind of volume growth.
All right, just one more number, sir. The ROC, you said you're happy at around mid-teens, is it?
We have reached mid-teens. And we would like to be somewhere around that.
Okay, all right. And also the debt number in the books, I think most of this capex that you're talking about, 1,000 crores, will be done from internal accruals. What is the updated debt in the books? Your interest cost is, I think, 250 to 70 crores per annum. So what is the net debt in books?
The debt was, as of 31st March, around 1,600 crores. And it has a huge negative working capital, which is not sustainable. So we would need a little bit more in terms of working capital engagement, and that 1,000 crore capex is also there. So we don't see too much swing in the debt level right through this year. Neither too much positive, not too much negative.
All right, not much swing. Let's talk about the market share then, and your off-highways business. Market share, the last known number was about a third in two-wheelers, and you had, just about 15% in passenger vehicles. What is your aspiration for the end of this year and the year after for both two-wheelers and passenger vehicles when it comes to market share?
If you're talking about market share in replacement market, our market share in two-wheeler is in excess of 35% at this point of time. And we would like to consolidate the lead with the next player, expand the gap, which is at around 5% right now. In passenger car tire, we are nearing 17% basis last quarter. And we would like a gain of anywhere between 0.5 to 1% by end of this year. We are a smaller player in truck bus radial segment, where also we are seeing some gains coming in this year. We are going to get commercial production from our Chennai TBR capacity starting Q2, going into Q3. So that will come in handy to increase market share in TBR as well.
And what's your target from the off-highway business over the next couple of years?
Off-highway business is primarily focused on international markets, so market share is not a relevant metric there, but it should contribute heavily to doubling of export turnover, which we are aiming for taking the saliency up to 25%.
Okay. All right, Mr. Banerjee, we will leave it on that note. Thank you very much. It was an exhaustive conversation, helpful one, and we wish you good luck for the rest of the year.